What if I told you you can make $1,500 in about 30 seconds using this option strategy? It sounds pretty good, right? And almost too good to be true. Well, you don't know anything about this trade. I probably have your attention with that headline. That situation, I'm talking about selling a covered call on a meme stock like AMC. And it's where you own 100 shares of a stock and then you sell a call against it. In this video, we're gonna be talking about kind of the different scenarios and different underlyings that you can pick to use this strategy, and how they can be drastically different when it comes to the total return, but then also the total risk that you're taking. Just to prove I'm not lying to you guys, here's AMC. It's currently trading at $57.50. So if you buy 100 shares, you can sell a covered call against that position or the 100 shares for around $1,500. So this $15 you'd multiply by 100 shares per contract. So you're collecting $1,500 up front for selling this call with a $60 strike price and around 52 days till expiration. Now, if you're new to options, you probably don't know a lot of what I'm talking about right now. So let's talk about what exactly a covered call is. The easiest way to understand it is understanding what a call option is, which gives the right to the owner of that call option to buy 100 shares of that company at a specific price, which is that strike price, up until a specified date, which is the expiration date. Going back to AMC as an example, this is the $60 call that we're talking about. So if I'm buying it, that means the strike price is $60. The expiration is August 20th, so 52 days till expiration. And I'm buying the right to purchase AMC at $60 per share for the period that the contract exists. If you're the buyer of that call option, you need the stock to move fast and in your direction. If the stock trades sideways over the period of your contract, the call option loses value. If it goes down, you lose value. You need the thing to go up and surpass the amount that you're paying in that $1,500, which is known as the premium. So really, you need the stock to be above $75 by expiration just to break even. That's from the buyer side. Now, if you're the one selling the call option, you benefit if the stock trades sideways or it falls, because this call option would lose value. So you're selling it for $1,500 and the hope is that you buy it back for less money. Now, if you sell the call without owning any shares, this is known as a naked call, and that's extremely risky because it's unlimited downside or unlimited risk. If the stock somehow decides to explode to the upside, you don't have a cap on your losses because you're essentially shorting the stock at 60. Whereas if you own shares, it's known as a covered call because you get the stock appreciation, but you're basically capping out your gains at $60. Because if the stock goes to 120, sure, your call option has exploded in price, but you also own the 100 shares underlying. So you would sell your 100 shares at $60 and you basically collect the premium as well as collect the stock appreciation. So if you bought at $50, you would get $1,000 on the stock and then $1,500 on selling the call. Now, the real question is, why the heck are you getting $1,500 for selling a call? It's not normal, and we have to look at the implied volatility, which shows what the market is expecting AMC to do. This implied volatility number, the 196, shows that the market is expecting a large swing in the price of AMC within these 52 days. The larger the number this is, the bigger the swing that's expected. Now, with a higher implied volatility, that means you're collecting more for the options that you're selling. At the same time, you're paying more if you're buying the options. To really paint this picture, we can look at a company like Intel, a boring boomer stock that pays a dividend, is considered more of a value stock, and has a large market cap. With that boringness comes a lower implied volatility because the movement in the stock is not expected to be as large. So you can see the implied volatility is only 35%. Now, this stock trades actually in a pretty close price range to AMC right now. So it's trading around $57. So if you sold the same expiration date, 52 days out, the 60 call, you're collecting only $130 compared to AMC, where you're collecting $1,500 versus $130. Obviously, that's a huge difference. It really comes down to risk versus reward. So with AMC, the stock price isn't really attached to reality. Let's admit it. AMC is not trading on the actual valuation. It's more of a trading vehicle and like a battleground between hedge funds, retail. No one really knows where the stock is going. So it could go to 100 or it could go to 20. And that's why the option prices are more expensive, because realistically, either option could happen. Whereas Intel, it's trading at 57, where the intrinsic value of Intel may be 57, 55. So there's kind of a bottom floor where Intel isn't realistically going to go. So it's not going to crash to 30 overnight out of nowhere, because, hey, there's cash flows and a business that's behind that stock price. Personally, I wouldn't go into a covered call into something like AMC, but if I owned shares before the explosion, I would probably be selling calls against it. So if I owned 200 shares at $10 and now we're trading at 57, that's one of those situations where, okay, I bought at 10, I'm totally okay with selling at 60 for a profit, but now I can actually sell calls and just get paid. And if the stock kind of stalls out right around here, 55, well, these call options deteriorate in price, and all of a sudden I'm pocketing that cash, and boom, my cost basis is basically paid for, right? If I collect $3,000 in option premium and I only paid $2,000 for the 200 shares, it's a win-win. It's kind of one of those situations where I would only sell calls against AMC if I already own the stock. Let's talk about some of the pros and cons with covered calls in both situations, right? It doesn't matter what the stock is. If you're selling a covered call, you are limiting your upside. So with AMC, if it exploded to $120, well, you don't get to sell it at $120. You have to sell it at 60 because you sold a call against it. Another downside is if this stock that you sold the call against actually crashes in terms of 50, 70, 80% and never recovers. Because yes, you collected a premium, but now you own the shares that have lost way more than the premium you collected. Pro side is if the stock trades sideways, if implied volatility contracts, if it goes down slightly, well, all of a sudden you're making money from selling the call, versus if you didn't do that, well, you would have just lost money on the stock going down. For me, covered calls is more of a trading strategy versus some people want to use it in a long-term portfolio. The danger of using it in a long-term portfolio is if I really like a stock and I want to hold it forever, selling a covered call against it, well, I may have it get called away, meaning that it goes past my strike price and all of a sudden someone is exercising it. Well, if I want to hold that stock forever, it's kind of silly for me to sell a call against it. Now, what you can do is you can wait for a stock to really get overbought and sell a way out of the money call. So the stock would really have to move in a quick and fast way to the upside in order for you to have your shares called away. Now, the further out of the money the call that you're selling, the less money you're collecting, but at the same time, there's less risk of losing those shares that you own. My style would be more to sell covered calls on something like Intel, because I may think the company is intrinsically valued at $60 per share. I'm okay with buying the stock at $56.50 because I think it's worth 60. Make about $350 from the stock appreciation if it went to 60 or above, and I would also get to collect that $130 from selling the call option. And I don't think the stock is going to, drop 50% overnight out of nowhere. Realistically, this $130 that I'm collecting, I'm kind of lowering my cost basis from 56.5 to more around $55. Also, ideally, the IVR, the implied volatility rank of the stock option, would be above 30. An IVR is a scale between 0 and 100 showing you the past 52 weeks and where implied volatility is compared to the historical average. So 100 is at its high point, 0 is at its low point. So I usually look for above 30. That way I'm collecting a decent amount of premium when I'm actually selling the call option. There you have it. Now you know the difference between selling call options or covered calls on meme stocks versus more regular stocks like Intel. And you can make a killing on the meme stocks, but always remember there's that risk reward where there's a reason that the call options are more expensive when it comes to these highly volatile stocks. So trade carefully and watch the sizing of your positions, because risk management is still always king when it comes to trading options. If you did like this video, smash that like button and consider subscribing to Main Street Wolf, where we talk investing, stock options, anything to do with money. Thanks guys for watching, and have a great day.